Let's talk about one of the best trading setups of the year, and it comes back every year. I want to talk about the trading tendencies, the seasonal patterns of December, but not like how most people talk about it. I don't want to look at statistics and numbers. I want to dive deeply into why it works, how it works, and how you can really apply it to really impact your process. This is something that I've paid so much attention to each December, and honestly, it's ended up being a big part of my profits, of my annual profits, many years. Now, the first thing I want to talk about is how I don't like to use seasonal tendencies. There's a lot of work done on it. I've studied it very closely. It bothers me to look at, between May 3rd and May 7th every year, the market's up 92% of the time. That doesn't really work for me. It may be an aberration, just a surprising tendency that has occurred in the past. I want to have a real fundamental basis for why something works. So if you look at other markets, for example, commodity markets, obviously there's a strong reason why certain seasonal tendencies would show up in crops like corn or soybean. There's growing seasons, there's typical weather patterns. But what impacts stocks? There's one seasonal tendency that is very relevant for stocks, and that is taxable gains, taxable losses. And that, in my opinion, is really what drives these two setups that we're going to look at today. So because this revolves around taxes, the main focus is if you have a large gain on the year on a stock. Let's say, for example, you have a 100% return on Palantir, and that equals to a $500,000 gain. It's a great trade and you're really happy with it. Well, if you sell it on December 23rd, you're going to owe a lot of money in taxes this year. If you can push that over till next year, you can delay that tax payment. So there's a very strong incentive to avoid selling your stock as you get into the middle of December, because just a short while forward, you'll have an opportunity to sell that same stock but not incur the same taxable event. And on the flip side of that, if you're stuck with a stock that's been a terrible performer, not only are you frustrated by it, but if you sell it in the current calendar year, you can use that loss to offset gains you've made elsewhere. So this taxable difference between gains and losses has a very big impact on the flows at the year end. And this really impacts both the best performing stocks and the worst performing stocks. And it actually exacerbates them both in both directions. But if you can time them properly, it creates some pretty amazing opportunities over a very short period of time, just a couple of weeks, a week, 2 weeks, 3 weeks. But these stocks can move tremendously quickly, and that could equal to one heck of a good return in a short period of time. So let's jump into the charts and let's look at both examples. Let's look at how great acting stocks, how great performing stocks act at the end of the year, and how some of the worst performing stocks act at the end of the year, and how you can take advantage of both scenarios. So of the two strategies, we're going to begin with what is probably the more consistent but less powerful of the two. Later on, we'll look at something that's maybe a little riskier but has the most potential upside, some pretty impressive upside in the short term. Let's begin by looking at stocks that have had a great year. I think the QQQ is a great example in 2024. Basically everyone sitting in this stock is at a profit this year. It started at the very lows. We're sitting at the very highs. So this is a good example. Whatever we talk about now in a moment, I'm sure we'll probably be applying to the market this year in 2024. Luckily, if we go back just 1 year and look at 2023, we get a near carbon copy where we started at the lows of the year and really closed up near the highs. So zooming in a little bit, as I mentioned before, anyone sitting with a gain probably doesn't want to sell the stock after such a great year just a couple of days before the new year. So you always end up with this upside vacuum where basically there's no one wants to sell and just the net buying will come in and push the stock higher. And this is really what drives the Santa Claus rally period, in my opinion. But you'll notice here as well that as soon as that lack of selling ends, we get a quick drop into the start of the year. And typically, people who don't have to concern themselves about large gains, maybe they're getting short, maybe they're just selling some smaller profits so they don't have the same kind of taxable concerns, or maybe they're just buying a lot of puts and that draws down the stock. You'll see that the selling usually starts a couple of days ahead of the new year, most likely short-term traders taking advantage of all of the sellers who will come in on the beginning of the new trading session. So you end up with this two-sided trade, one where you can really maximize, really step on the gas and try and take advantage of that strength going through the Santa Claus rally period. And just as you get into the last couple of sessions before the new year, look to backpedal out of the position and really plan, if possible, for that downside move. Again, either people can go short, you can just sell your take your profits, or maybe even buy puts if you prefer to do it through a more limited risk type of way. But just to show it's not just a one-off, let's take a look at some other good years. I think 2021 is a good example. Now, you can see going into this year, similarly, we started near the very lows of the year. We finished near the highs of the year. Most people sat with a profit. And although it was choppy in December, you can see those last few days, basically the index was able to just levitate higher as the sellers just backed away before the new year to do some selling. And you'll see again, the actual peak happens a couple of days before. And as soon as the new year starts, you get downside selling pressure. Now, I don't want to say all of this selling is due just to this tax strategy or this seasonal strategy. The macro picture always plays a very important role, and that's why this year was exacerbated in 2022 because of the rise of inflation and all of the rest. But you will see that very strong dynamic take place at the end of the year. We can take a look at 2020. Here, again, though there was the COVID crash, ultimately, most people ended up with a nice profit on the QQQ. And this is a good example where here the macro influences were more positive. The central banks, governments around the world were still throwing money at the market. So we got that same end of year levitation higher. And when the new year started, you did get some weakness, but it wasn't as long lasting as like we saw at the start of 2022. There was still so much money coming to the market that ultimately we had this push higher. So if you go back in time, you'll see the same dynamic. You can take a look at 2019. This was another example of where we had this very strong upside going to the end of the year and then some volatility at the start, but nothing significant in terms of downside. But so you can really kind of play the strategy how you think it's best. You can go back and look at other years as well, such as 2013, 14, 15, 16, and you'll see this very similar dynamic of strength into the end of the year and then quick sell-offs at the start of the year. So I really recommend you take a look back and you'll see these environments. Now let's take a look at what is, I think, probably a riskier type of setup, but a lot more potential upside if you get it right. Let's go to GDXJ. So this is the junior gold ETF. I was a market maker for many years, and a lot of the stocks I focused on were these junior gold stocks. So I knew the industry very well, and it's a tough industry. It's not easy to make money for these companies. You can see going back in time, this is hardly like what the NASDAQ has been able to pull off. So if we go back to, I'll go relive some of these monster trades I was able to put on. Look at 2013. Look at this. This is kind of the opposite of what we looked at with the QQQ. This is a very bad, one of the worst performing stocks of the year. So what happens is, unlike the QQQ where people are avoiding selling their stock to take a taxable gain, here people are, it's in their interest to actually sell the stock within the same year to take a taxable loss. So anyone sitting with, let's say, a gain in NVIDIA, they're probably going to get a call from the investment advisor, say, hey, look, you have this big gain with NVIDIA. Why pay taxes on that gain? Sell these awful junior gold stocks, which have just fallen throughout the whole year, and you can offset your tax bill. At least, that's the very least these gold stocks can do for you. That's probably the phone call many people will get at this time of year. As a result, you'll get an artificial amount of selling going right until about the middle of the month, just about the 20th. Probably most people aren't really thinking about the market on Christmas Eve or the day after Christmas. So this really ends about middle of the month or just before Christmas. And you'll see once that bottom is in, you can see here from that 2013 bottom into just the beginning days of January, you had a 32% advance in just 18 trading sessions. If we go ahead one more year, we can look at 2014. Similarly, ultimately, you ended up right back near the lows of the year for GDXJ after what was a hopeful year at one point. Those same the phone calls were going out, and the market, the ETF here bottomed on the 16th of December, had a bit of a retest right around the 23rd. But ultimately, off of those lows, you advance 43% in just 23 bars. Again, there's so much selling done. You get this artificial drop in the stock that just having that work back up the other way provides a lot of upside. 2015 is another good example. This is a good example of where the stock ultimately did close near the lows. It wasn't as weak a year as others, so there probably wasn't as much selling pressure. And also, similar to the QQQ, the macro backdrop will have an impact. So if you go back to this time, late 2015, early 2016, China was having a lot of economic problems, and commodities in general were very weak. So this stock, the ETF did bottom here December 17th, right around that same time. And we did get strength into the start of the new year, but ultimately was dragged down by China until stimulus measures got all commodities going vertical. So although there was kind of the macro impact, this didn't immediately have as straight a move up. You can still see the dynamic of the tax loss ending and then that rebound trade higher. If you look at 2016, this is a good example of where the ETF did close higher on the year, but probably so many people were caught with losses. There was still a very strong tax loss selling that took place right until the 20th of December. And then you had an even more powerful 55% rally in 33 bars. This is a trade I always would put on all of these years. I put this trade on with size. These were really great trades. So it's riskier because you are dealing with lower quality companies. If the stock is at pretty much the lows of the year, there's something not going on that's very good for this company. I mean, there's probably having a hard time. There's headwinds, there's risks. So you need to understand what you're buying. What was nice with a GDXJ or some of these gold mining stocks, you can have a diversified approach to putting the trade on. So they are high risk. This is not financial advice, it's educationary. So always keep all of this in mind as you kind of look for setups. But specifically, if you do like a company, you think it's a value play, you think it's overdone, there's probably no better time to be searching for value plays than right in the midst of tax loss season. Again, 2017, pretty rough year for most of the year. We bottomed right around, even a little bit earlier, 7th, 8th of December. And then we had this big run right into the 25th of January, 24th of January. So again, I recommend you kind of take a look at some other really bad years. You can take a look at 2021, 2022, how those kind of played out. But these are two strategies, really looking at the best stocks. We looked at the QQQ as an example, and looking at what are some of the worst stocks, which you use the GDXJ as an example. But this general strategy will work on many securities, many ETFs. So once you understand the logic, you can apply it to your trading in different ways. Again, that's really what we try and do at Caruso Insights, really bring all this stuff together into a holistic. So regardless of your investing process, why not incorporate this very strong seasonal tendency into your year-end decision making? Either it can set up some new trades that you don't have on, or it can help you to maximize and optimize your trades going into the end of the year. If you enjoyed this video, there's a lot of free resources, articles, blogs, white papers available on my website, crusoinsights.com. Also, most people who watch these videos don't subscribe to the channel. Please subscribe. It'll help build up the channel. We'll get more content out there and you'll be notified when great new content comes out. As well, you can follow me on Twitter at trader_mcaruso. I wish you a great rest of the year. We'll be back soon with some new videos. Thanks.